Hi there, welcome to The Street on BNN Bloomberg. I'm Lindsay Biscaya. Coming up on the show today, Kyle Taylor at TriDelta Private Wealth will be joining us for the hour. He's got strategies for retirement planning you won't want to miss. Also, how AI is helping in cancer detection. Joining us to talk about this is Jean Seeley. She's head of the breast imaging section at Ottawa Hospital Research Institute. And we want to hear from you this morning on First Call. You can call us with your questions, and we will have Kyle Taylor answer as many of them as he can at the end of the show. The number to call, though, will be 1-855-326-6266, and we will open the phone lines in about 30 minutes from now. Our email address is firstcall@bellmedia.ca. And now here's some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump is getting ready to launch a strategic critical minerals stockpile. According to Bloomberg, the $12 billion stockpile is aimed at protecting manufacturers from supply shocks and cutting America's reliance on Chinese rare earths and other metals. Shares of Disney are edging higher in the pre-market. The media and entertainment giant posted profit and revenue in its fourth quarter that beat estimates, boosted by a record $10 billion in revenue. And for the full year, Disney is expecting double-digit growth in profit and is set to buy back $7 billion worth of shares. And we're watching shares of Tyson Foods in pre-market trading as well today. The meat producer reported sales and profit in its latest quarter that topped Wall Street expectations. The company's beef business reported a $143 million loss in the quarter, and Tyson will close a beef plant in Nebraska. As a result, the company narrowed its expected operating loss in its beef segment, but maintained its outlook for the year. And now to our top line story this morning. It's another earnings week, which is upon us, with some big names like Disney and Canada Goose set to report this week. So for more, we're going to bring in our guest for the hour, Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. It's good to have you join us. Thanks for coming in studio.
Thank you for having me.
So if we look ahead to the week ahead, any big names stand out for you? Anything you're particularly watching for?
Well, it's certainly already been a very big couple weeks, and earnings have been overwhelmingly positive in general. But I think you have to look at Google and you have to look at Amazon as two of the biggest reporting this week. Google, they've really been emerged as the AI darling. They have, simply put, the best model and a great distribution for that model. And I was reading something really interesting over the weekend, actually, just in comparison to some of the other models that are out there. Google's Gemini 12 months ago accounted for about 5% of all AI-related online traffic a year ago. Today, it's actually at 22%. You compare that to ChatGPT's through OpenAI, it was 87% a year ago, and it's 65% today. So I think that there is some ground being made up on Gemini. There was the news with the partnership around Apple. YouTube is also a behemoth for them. So I think that they're really well positioned as moving forward. Amazon was in the news last week with some significant job cuts. Yeah. There is a reported investment into OpenAI of about $50 billion. That adds on an existing investment that they already had into Anthropic. I think Amazon is still a retail behemoth. They're actually cheaper than Walmart today in that side of things, but people will be very cognizant of the cloud services side of things. Apart from that, there was some interesting news later last week with a new Google AI tool, which is seen as a world-building metaverse tool that was negatively impacting a lot of the video game stocks. Roblox was down about 13% on Friday, and Take-Two and Electronic Arts are reporting later this week as well, and I think it'll be interesting to see how they address that.
It's interesting because, we've been talking to some guests who were talking about AI, and some of the companies that are really big into AI and have had a lot of spending into AI, maybe not seeing the return they wanted. Do you see any companies that are being held back by AI as we see this latest earnings report come out for a lot of them?
Well, I think Microsoft was a really good example last week of a company that actually beat on sales and earnings estimates, but they didn't provide a clear timetable for generating or monetizing those AI investments. Also holding them back was the investment into OpenAI, which accounts for around half of their forecasted future revenues for the business. So that is something that I think it's been a tailwind for them the last couple of years. But if OpenAI stumbles or if there's changes in that space, then it could certainly be a detractor as well.
There is criticism as well of like overspending into the AI kind of infrastructure and all the technology and materials that are needed. Like, how important is it, do you think, for a company to have a clear return timetable as well?
Well, I think that's where Meta stood apart last week, is they were able to provide that clear timetable for when they expect to see returns and help to quantify it a bit more for investors. And I think the onus is certainly on these AI companies to demonstrate that. We're quickly moving away from the time where people were dissatisfied with being told about how great AI is, and very quickly they need to demonstrate that is true and that the investment is worthwhile for investors. And I think you'll see that tone from a lot of other, even non-AI related businesses as well.
Interesting. Okay, so we'll keep an eye on that. But in the meantime, we're also keeping an eye on the markets today and that sharp sell-off of gold and silver that we saw on Friday, continuing today. What do you think is behind this? I know most are pointing toward that Fed chair pick by Donald Trump.
Yeah, well, that played a big role in the associated USD rally in Friday, which makes metals and commodities generally more expensive for foreign buyers of gold, silver, and all those commodities. The other aspect of it was, I think, that there was increased retail activity from precious metals in the gold and silver trade. There was a lot of margin calls that went out on people borrowing to invest in these trades. As those unwound, that added some additional negative pressure. But I think the near-term volatility could also provide an opportunity if we do see some sort of a bottom or support on the low end, as we've continued to see some fundamentals around central bank buying, and I don't think that's really slowing down.
We've seen gold go on having almost a new record almost every day in the last couple of weeks, right? Silver as well. Like, was this maybe partially a correction that was needed with gold and silver, or something you were expecting?
Well, I think it's something that, when price is highest, risk is highest, and when things don't work out as expected, that can really challenge the narrative, and gold and silver was really demonstrative of that. And I think that's something that as Canadians we have to be acutely aware of, just based on the material sector here in Canada and how much of a concentration there is in that, and the run that we had in 2025.
Well, yeah, because we saw the TSX drop on Friday, and that was mostly led by all those gold and silver mining stocks.
That was a big component of it. We don't necessarily have the big tech sector that the U.S. does related to AI.
Wow, interesting stuff. Okay, Kyle's going to stick around, of course. We're going to take a quick break, though, here. Up next, we'll take a look at the markets before the bell. Stay with us. Welcome back. Let's take a look now at how things are shaping up on the markets, beginning with the U.S. futures this morning. You can see the Dow future contract, the NASDAQ, the S&P 500, all trading slightly down this morning before bells open. If we take a look at how major Asian markets finished the day today, they've been tumbling the most since April. The sell-off here mostly driven by tech stocks and precious metal stocks. You can see the Nikkei down 1.2%, the Hang Seng down more than 2%, the CSI down more than 2% as well. Overseas in Europe, we can take a look at how the European markets are faring today. They opened lower, but recovering slightly throughout the day so far, as you can see. And if we take a look at where the TSX finished the day on Friday, not a good day for the TSX, down more than 1,000 points. And we can look at some of the biggest winners and losers Friday on the TSX composite from a percentage standpoint. Brookfield Renewables was up 6%, the most on the TSX. 5 and Plus up more than, or almost 4%. If we take a look at some of the losers, though, the First Majestic Silver Mining Company down more than 16%. You can see in the materials sector dragging down the TSX Friday. NovaGold down almost 20% to end the day. And here's a look at how metals are shaping up to start this Monday morning. Gold futures trending up now, up about more than a percentage point after seeing some losses earlier this morning. Biggest plunge in a decade on Friday, and we're seeing a bit of a recovery for gold. Silver also trading up as well right now. Copper is still down, though, more than 1%. And if we take a look at crude oil plunging today. This comes after Donald Trump said Washington is actually in talks with Iran now. So we're seeing some geopolitical risks fading, and oil's down more than 5% as a result of that. Well, if you woke up this Monday morning and are dreaming of retirement, Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth, has some tips and tricks to get you there with a plan. So Kyle, I guess the first question I want to ask you is one you say you get quite a bit or you hear from people is RRSP or TFSA, is one better than the other?
Well, ideally it's both.
Okay.
If you have the capital to contribute to both annually. But the way the math does work out is that if you are contributing to your RRSP and then you're planning to reinvest that associated tax refund, the math does actually favor the RRSP contribution a bit. But I can't discount the TFSA. It adds a lot of flexibility for your portfolio as well as your eventual retirement and estate planning.
You say another consideration, another good one, is a spousal RRSP. What is that?
Yeah, I think there's a few additional considerations that people should be making with the March 2nd deadline for RRSP contributions. Spousal RRSPs are one. You see those where one spouse has significantly higher income than the other. This allows that spouse to contribute to the RRSP, receive the deduction in their name, but then the eventual withdrawals for retirement are taxed in their lower income spouses' names. And the other caveat there is, and one that people don't often take advantage of, if the two spouses or people in the common law relationship are of different ages, say one person is now 73, their wife is 66, well, me as the 73-year-old, I can actually contribute to a spousal RSP, get a deduction, and my wife would get taxed on that when she converts that to a RIF account later on. That's something that wouldn't be available to someone if they just held an individual RSP. The other consideration, and I think it's very topical because of some of the emails that go out this time of year around RRSP loans from all the big banks, and do they make sense for you? Most of the time, I would actually say probably not. Ideally, if they can work the math if you are contributing your own money as well as doing the RSP loan to make sure that you can pay off that loan immediately. But otherwise, you might be stuck with some additional borrowing that you hadn't anticipated.
Okay, so for people who are maybe nearing the age of retirement, getting close, starting to look at it, what should they be looking at?
Yeah, I can't overstate how important it is to plan properly for retirement. And I really think that there's a missed opportunity that a lot of Canadians sort of in that 50 to 60-year-old range are missing out on. And I think that's partly because something I'm seeing more and more these days is that people are looking to retire early, whether that's age 60 instead of 65, or they're looking at doing some sort of phased retirements where they're stopping full-time work at age 60 and they're going to work part-time for a few years thereafter. And one such strategy that can be really important is actually called the RRSP meltdown strategy. And what this does, and it's very specific to the individual and to the household, but it requires withdrawing from your RRSP before converting it to a RIF or before you're even retired in some cases. And it's especially valuable for people who have really great pensions or people who are retiring with significant TFSA contribution room available. And what it does is it can significantly lower the household tax bill over your life. It can also increase the flexibility of your portfolio because if you're someone with a great pension, eventually you're going to be forced to take those RRSP or those RIF withdrawals later on in life. And that can push you to a higher income level than you otherwise may be comfortable with or happy with because you're paying more in taxes. It also exposes you to some additional old age security clawback after the age of 65. So it can make a material difference. And I see it pretty frequently where someone's sitting in front of me and they're 70 years old, 75 years old, and we're going through what some of the opportunities that they may have missed out on, and all of them say, I wish I had made this consideration earlier because it can be a big impact.
Do you think people, like when they say I wish I was making this consideration earlier, we hear people that are maybe closer to our age or maybe not planning for retirement the way we should be, or do you find people even who are in their 50s and 60s starting to look at retirement? Are they still planning accordingly, do you find most people? For
most people in the younger cohort, I would say that maximizing your registered accounts should be your primary objective between the RSP and the TFSA. Depending on your stage of life, I think there's some additional considerations for contributing to your RSP itself. For instance, if you're someone who is newly out of school, you're starting your career, and your income expectations are sort of up and to the right, then it can make sense to even maybe hold off on contributing to your RSP, let that contribution room grow, and then take advantage of it when you're in your higher income years. But for most people, I would say just focus on maximizing those contributions. And then for people who are sort of in those later stages, that's where I would say the sweet spot is for having these considerations, because you may determine that your RSP contributions are not optimal because of a great pension or a locked-in employer-sponsored plan that you have through work, stock options. There's so many different considerations apart from just making sure that you're putting the money towards these different accounts.
And just lastly, like some Canadians might have been getting notified by their banks that they're eligible for RRSP loans. What does that actually mean?
So RRSP loans is effectively you can borrow to then contribute to your RRSP. You would use the associated tax refund in a couple months to pay off that loan. The problem is if you take out a $10,000 loan and you just use that as your only contribution for the year, you're not going to get a $10,000 refund. Right. So you're going to be stuck with a bit of that loan balance, even if you put your full refund towards that loan. So when I say that it makes the most sense for people who are contributing their own money as well, maybe you put $25,000 in this year and you want to bring it up to an even 30. That can make sense because your associated refund overall is going to be more than $5,000, right, depending on your tax bracket. But for most people, I would say it doesn't make the most sense. And ideally, you're using your own capital to make these contributions.
Got it. Okay, so we're going to take another quick break right now. Up next, though, we'll be back with Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth, to see why durable businesses are on his radar. Stay with us. That's next. It is time now for On the Radar, and we're back with Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth. Okay, so durable businesses on your radar. You've got a couple picks here. We'll go through them. NextEra Energy is your first pick.
Yeah, well, I think generally utilities is a sector that I would highlight. And within the U.S., I think you really need to be highly selective, though. You can't just put a blanket statement that utilities are a great sector. Yeah. Because in the U.S., there's a very big difference between regulated and unregulated utilities. Regulated utilities are subject to these things called rate cases. Happen every few years. They effectively are a negotiation between the regulators and the lawmakers to set the rates that balance business investment along with the consumer appetite. And NextEra has a really great track record of engaging in those discussions in a way that is constructive and also benefits NextEra. And they're a Florida-based utility provider in wind and solar. They have some sizable contracts with Alphabet's Google as well as Meta. And I think they're in a really good position, a favorable environment that they operate in.
Centrica PLC, another one?
Centrica is a UK utility provider. I think Europe is worth a look in terms of the AI power demand. And UK is actually, they're expected to account for 20% of the overall power demand between now and 2035 in Europe. And I think Centrica is a good way to play that for investors.
You're of the mind to kind of look overseas as well? Like don't just stay in North America when investing?
Absolutely. I think you have to, especially today, given the headline concentration in the indices in the US and Canada, and just from a diversification standpoint in terms of currencies. And so there's some really great businesses out there.
Okay, so next up is from the healthcare sector, Eli Lilly.
Eli Lilly is, of course, a behemoth. Gets talked about all the time. They've been a very big beneficiary of the weight loss drugs. And what's interesting to them is they had a ruling. There was a development late 2025 from the Trump administration that these weight loss drugs were going to be eligible for Medicare. That actually expands their addressable market by about 40 million people. And you add on the fact that they're still only about 6 months out or into the rollout of their drugs in Europe. So, and they're seeing similar indicators to what they saw when they first rolled out their drugs in North America, which is very positive. And on top of that, I think that the market really isn't accounting for the cash that these pharma companies have on hand and the investment that can lead to.
But when you're talking about these different companies like Eli Lilly, they do have competitors, but it seems as though they're out on top most of the time.
They of course have competitors. I think that this is a sector that particularly last year had some pretty poor sentiment. They're not as great a value today as they were, say, in August of last year, but I still think that there's some momentum to be had in that space. And you have to note that a lot of the negative headlines from the US administration in regards to healthcare, I view that as short-term noise and an opportunity for a longer-term investor.
Probably the same thing for the next one we're going to be talking about, which is your pick, Bombardier. Also had a rough day on Friday.
Yeah, Bombardier, I think, was an interesting case study for probably what's to come, because I think that the market is becoming very headline reactionary. And with Trump's tweet around putting a tariff on Canadian aircraft, as well as decertifying Bombardier jets, whatever that means.
Which you can't do.
Exactly. There are over 1,200 operators who use Bombardier jets just in the U.S. A lot of confusion, obviously. I think the stock was down at its low 8% and finished down 6%. All I can say is that I was adding to my Bombardier on Friday, and I think that there will be select opportunities like that for the next several months as the USMCA negotiation heats up, and there will be tweets and there will be headlines, and I think really you just need to look at the fundamentals of the business and kind of almost not put your blinders on, but realize that the worst case is not always the base case.
Realize that there's more to the business than just, rhetoric coming from the White House, right? Because like Bombardier, I'm just looking, is reporting its fourth quarter next week, I believe, or February 12th, whenever that is, might be next week.
Yep.
So obviously the company itself, despite, political noise, still doing well.
The company's had a great run, and I think that I think the Canadian positioning around expanding our trading partners is a benefit to Bombardier, and I think that's been reflected in the stock over the last year or so.
Okay, we're going to take another quick break right now. Still ahead, though, our next guest will talk about how artificial intelligence can improve mammogram screening. So that's coming up next with Jean Seely. And of course, our phone lines will open soon for our first call segment. Here's the number you can reach us at, toll-free, 1-855-326-6266. Or you can send us an email, firstcall@bellmedia.ca. We're going to be right back after this break. Shares of Eldorado Gold are lower in the pre-market trading today. Eldorado is buying Foran Mining for $3.8 billion to create a gold and copper mining company that will produce about 900,000 ounces of gold in 2027. The deal will also bring together development projects in Greece and Saskatchewan. The combined company will remain headquartered in BC under the Eldorado Gold name. U.S. President Donald Trump is getting ready to launch a strategic critical minerals stockpile. According to Bloomberg, the $12 billion stockpile is aimed at protecting manufacturers from supply shocks and cutting America's reliance on Chinese rare earths and other metals. The reserve will include minerals such as gallium and cobalt used in products like iPhones, batteries, and jet engines. And we're watching shares of Tyson Foods in pre-market trading today. The meat producer reported sales and profit in its latest quarter that topped Wall Street expectations. The company's beef business reported a $143 million loss in the quarter, and Tyson will close a beef plant in Nebraska. As a result, the company narrowed its expected operating loss in its beef segment, but maintained its outlook for the year. And we'll take a look at the U.S. futures this morning, all trading down this morning before the opening bell. The Dow, the NASDAQ, and the S&P 500 all down less than a percentage point. A new study has found late-stage cancers decreased 12% in groups where AI screening was implemented, suggesting AI could become a new wave for medical breakthroughs. Here to talk about this technology's ability to detect and prevent breast cancer is Jean Seely, head of the breast imaging section at Ottawa Hospital Research Institute. Kyle also here in studio to join us for this conversation. Jean, it's good to have you. Thanks for taking the time.
Thank you for having me.
This is really interesting. I'm wondering, first of all, if you can explain exactly how this works when it comes to breast cancer screening and implementing AI.
Well, the study that we're talking about was done in Sweden, and they implemented it for a population-based screening program where they usually in their country do double reading, where two radiologists read the mammograms and then decide whether or not they need to call back the patient for additional imaging. Instead of using a second human radiologist reader, they added AI, and for the cases where the AI flagged the mammograms as being higher risk for getting breast cancer, they studied the impact. And what they found was having the second reader as being the AI actually improved the performance of the overall program and reduced the late stage the delayed or advanced interval cancers by 12%, as you mentioned. So
Wow.
This is a really positive step to show that AI helping the radiologist actually improves the performance of the program.
No kidding. I'm wondering, like, obviously we'll be seeing more of this, I'm sure, in the future. And you suggested that this technology can actually save public health dollars as well. Do you have an estimate in terms of like how much we could see?
Well, we did a study a couple years ago looking at the cost of diagnosing breast cancer according to the stage at diagnosis and using Canadian healthcare dollars. And when we diagnose early stage breast cancer, it costs about $40,000 to $50,000 per patient. But the moment we get into the later stage, for example, the stage 3, which are more likely to be the delayed ones missed by the mammograms, those have a cost of over $200,000. And by the time it's already spread to the rest of the body, we can be in over $360,000 to $500,000. So when we add those costs up, using AI to help us reduce those late stage diagnoses will actually potentially save healthcare dollars.
Jean, what sort of adoption are you seeing with AI in hospitals?
I think you were saying what's the uptake in
What
hospitals?
sort of adoption are you seeing at the hospital
Yeah.
level to use AI, whether that's enhancing patient experiences or on the research?
It's a great question. It's still early. We have been using it at the Ottawa Hospital for the last year and a half, where I was able to use research funds to actually allow us to study the impact of adding AI to our screening mammograms. It's really early to say, but we are not finding that it increases the false positives when the radiologists are trained properly on how to use it. There is no way that we are ready to use AI as an alternative to radiologists. There are too many false positives where it would recall too many cases. But using it with the radiologist seems to help it. And we are starting to see this across the country where slowly people different radiology practices are starting to use AI to look at how they can improve their performance.
Okay, that was going to be something I wanted to follow up on too, right? Is like this study is based overseas, as you mentioned, but how often are we seeing, or how many areas of Canada are we seeing this technology slowly starting to be used? And to your point, like not alone, but with a radiologist?
Yeah, it's still early, and I would say there's a lot of interest. We're starting at many of the radiology conferences, we're starting to have talks on how this can be adopted. There's obviously the cost of implementing AI. There's there's a lot of hesitation to use it because it has this kind of black box phenomenon. We don't know exactly how it works, and we have to study its impact on human behavior. We can't rely only on AI, and so there's a learning process. So I would say it's still fairly early, but I think it's very promising, and certainly from our experience, early as it is, it's helping us. And certainly from this study from Sweden, this is very encouraging that it's going to help improve the quality of screening mammography and early detection of breast cancer.
No kidding. You mentioned this, though, and I just wanted to dive deeper into that question of how much the actual technology costs. Can you give us a better idea of how much that costs?
It's so variable, and it's also changing, and there are different, and luckily Health Canada will have approval processes for all of the new vendors that are coming out. It's all validated, tested. So it varies depending on how many patients you're doing, how many mammogram units you're doing. So it's not insubstantial, and you have to integrate it into the systems to allow the radiologist to see this when they're working. So that requires a fair bit of work to implement this. So I would say we probably need help with implementing this across the country. I would like to see us do this more at the programmatic levels in the screening programs so that we can benefit all of the people in the screening programs, not just in a few centers.
And I'm assuming a lot of patients would obviously like to see more of this. Like, have you heard positive feedback so far from women across Canada who know that this could be more available in the future?
I think, and in speaking to my patients, they want us to be able to do the best job possible with the technology that we have. So if it's going to help and improve the quality of the imaging, then the patients would like it. We know from surveys that patients do not want radiologists replaced by AI. They want to have oversight. And I think that's exactly the way we're going certainly in Canada and many parts of the world. It is not ready. We need to have the radiologists integrate with the AI as this very valuable tool to help improve the quality.
So great to hear that there's an even more hopeful future on that front coming up. Okay, that's all the time we have. Jean Seeley, though, head of the breast imaging section at Ottawa Hospital Research Institute. Thanks so much for joining us this morning.
Thank you for having me.
Thanks. Well, still ahead, oil plunged as geopolitical risk premiums faded after U.S. President Donald Trump said Washington is talking with Iran, while a broader commodity sell-off exacerbated the slide. Our colleagues at Bloomberg will bring you the latest on this increasingly tense situation. Plus, our phone lines are open. Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth, is taking your questions this morning, so you can call us. The number's here, 1-855-326-6266, or you can email us at firstcall@beltmedia.ca. Iran's Supreme Leader Ayatollah Ali Khamenei warned of a regional war as tensions continue to mount over potential U.S. strikes on Tehran. U.S. President Donald Trump signaled Khamenei's threat didn't surprise him and said he's hopeful that we will make a deal. Bloomberg's Jomunana Berchetti reports from Dubai.
This gentleman regularly says he brought warships. The Iranian nation will deliver a firm blow to anyone who attacks or harasses it. The Americans know that if they start a war, this time it will be a regional war.
Why wouldn't he say that? Of course he would say that, but we have the biggest, most powerful ships in the world over there, very close, a couple of days, and hopefully we'll make a deal. If we don't make a deal, then we'll find out whether or not he was right.
Today is perhaps a very different circumstance or set of circumstances than where we were on Friday, when you had oil trading closer to $70 and perhaps the real possibility of military conflict over the course of the weekend. But things seem to have turned, judging by the price action today. And the window for diplomacy, once again, seems to be opening up. Of course, we did just hear those comments from the Supreme Leader, the Ayatollah there, threatening the U.S. that if they did strike Iran, that it could open up the possibility of broader regional conflict. President Trump quipped on the back of that, of course he would say that, but that he is actually hopeful of a deal. And we know over the course of the last couple of weeks, the U.S. have been building up what President Trump has described as an armada of military assets around the Arabian Sea, perhaps to provide some deterrence. But over the weekend, diplomacy has been playing an active role. We know that the Egyptian president held a call with various leaders in Iran. The Qatari Prime Minister and Foreign Affairs Minister also actually paid a visit to Tehran. He met with the head of the National Security Council, Ari Larijani, who's very close to the Supreme Leader. And after that, Mr. Larijani put up a post on X saying that a framework for negotiations had indeed been agreed to. We don't know at this point, Lizzie, what the terms of those negotiations are going to look like. From what we know from prior discussions, that the U.S. obviously have been pushing for a zero enrichment policy, obviously no nuclear weapons, but then also perhaps a new element, which is an end to their ballistic weapons program and the seizing of funding of military operations and groups around the region, including the Houthis and Hezbollah. So still very early stages, and it could very much be a situation where the two sides are buying time. But judging by the price action this morning, it looks as though we've walked away from the brink of military action to wait-and-see mode once again.
OK, so traders focused on the diplomacy. But, Jomunana, in the background, the OPEC Plus groups decided to keep production levels the same. How significant is that decision for the market?
Well, there was no surprise, really, that OPEC Plus didn't do much. And actually, it was interesting that even in the run-up, when Brent hit $70 last week with all of that geopolitical premium priced in, their reaction was to stay the course, because at this point, there are still a lot of unknowns as to whether this is going to broaden out into broader regional conflict, whether the Strait of Hormuz could be a target. We've spoken about that many times before, whether we could see supply disruption. None of that has actually happened. And I think as far as OPEC Plus are concerned right now, they would rather keep their chips close to their chest and see how things evolve over the next couple of months. But we still are in an environment where fundamentals would dictate lower oil prices simply because of this mismatch between supply and demand. You have many think tanks out there, including the IEA, forecasting a very huge surplus of oil versus oil supply versus demand over the course of 2026. And that was one of the reasons why at the beginning of this year you saw oil trade closer to $60 than where it is right now. So some people are saying that actually what was interesting about this OPEC Plus meeting is not what they decided, which is to stay the course for another month, but what they didn't say about the outlook from here onwards, because they don't want to pigeonhole themselves into a certain course of action. What I will say, though, is that they still have perhaps another 1.3 million barrels per day that they could bring to the market, and many members are indeed pushing for them to resume once again bringing those extra barrels to the market again. So we have to see how this all plays out. But today, the reaction in oil is perhaps reflective of the fact that some of that geopolitical premium is being priced out.
Still ahead, we will take a look at some of the notable analyst calls and recommendations moving the markets, including Shopify. That's next. Stay with us. Let's take a look now at some of the notable analyst calls and recommendations. We'll start with Shopify, which is being upgraded to buy from neutral at Arete, which writes that the e-commerce platform looks attractive in the wake of recent weakness. Shopify is down more than 25% off an October peak. Some analysts say Shopify still has potential to gain. Price target is set at $175 USD from $166. McDonald's was also upgraded to a buy from neutral by BTIG LLC analyst Peter Sala. He says a higher disposable income and a lower tax burden for low-income consumers could catalyze sales growth. And while inclement weather in January disrupted sales, analysts believe the underlying sales trends were healthy and, quote, should bounce back when weather normalizes. And we've got one last notable call this morning. Multiple analysts are predicting an early spring, including Ontario's Wyerton Willie. The groundhog did not see his shadow. We're, of course, watching that closely today here, and we will be watching to see how this impacts the markets as well. In other news, we're also following today, Manitoba's premier is set to visit Churchill this week to continue conversations around expanding the remote community's port. CTV's Alison Bamford has more in this report.
The polar bear capital of the world could also one day become a sea trade superpower.
Big energy play, defense, environmental protection. Churchill has it all in terms of nation building.
Ahead of the First Ministers meeting last Thursday, Manitoba Premier Wab Kinew spoke highly of plans to unlock potential at the Port of Churchill, announcing he will fly to the remote northern community this week to hear from locals, who he says should be at the center of the conversation.
I think the Premier being there is a really important step.
The port currently operates just 4 months of the year, shipping critical minerals to European markets and other supplies to the north. Ottawa has earmarked the port as a transformative project, seeing potential as a reliable part of a supply chain that could support military presence in the north and a gateway for year-round trade through the Atlantic.
Because of the geography of where Churchill is, it saves sailing time upwards to, a week of sailing time versus, say, going through Vancouver.
Saving time would save money, another factor making Churchill attractive. One expert says the expansion is quite feasible, but he questions what might happen to the town's other major industry.
It's one thing to be a big industrial port, and it's another thing to be a tourist town. And I'm not sure how you blend the tourist town with a big industrial port.
Manitoba's premier is scheduled to take part in a tourism roundtable and a town hall with community members in Churchill on Tuesday. He's also meeting with Indigenous leaders and expected to be on hand for a funding announcement related to marine conservation. Allison Bamford, CTV News, Winnipeg.
When we come back, Kyle Taylor, wealth advisor and portfolio manager at TriDelta Private Wealth, is taking your questions on First Call. Here's how you can reach us. We'll be back in just a moment. Welcome back. Time now for our First Call segment, and we are going to go to our inbox to start. We've got an email from Jimmy, and this email for Kyle reads, I'm curious about your view on the opinion of depleting an RRIF following your comments on early WD of RRSP to reduce tax liability when drawing down the RRIF. Is there a case for earning the most available potential gains for growth inside the protected zero taxable gains to cover any withholding regular income tax for the estate? Kyle, do you have the answer to that?
Well, it's a really good question, and thank you, Jamie. I would say there are some additional considerations often when we're making these decisions. Often it looks at the lifetime expected taxes, your estate bill at the end of the day, if you still have a living spouse. And one thing that I would note, though, is that zero tax on the gains and the growth in the RIF account isn't absolutely correct, because there is tax when you eventually withdraw those funds or you pass away and they're exposed. The full account is exposed to that tax bill. So I think it's actually a relevant one for me, because I actually just had this conversation with a client very recently where they're both in their late 80s and they have these large RIF accounts and they don't expect to need all of what's in there. So we came up with a plan which keeps them still within a reasonable tax bracket, but they're drawing down their RIFs a little bit more aggressively. And the lifetime tax bill that saved was in the tens of thousands.
Okay, so we're going to move on now. We've got Bo calling in from Mississauga with a question for Kyle. Hi, Bo. What's your question?
Well, first, I had foreign mining. I bought it like last year, and they're sending it, but he said he couldn't answer that. So my question is on Bell Canada as a long-term hold. I made a lot of money in Rogers, and I bought Bell Canada for about $32. So I want to know if it's a good long-term hold. Thank you. Bye.
Okay, thank you. Okay, BCE, parent company of BNN Bloomberg. I just have to disclose that.
Yeah.
Your thoughts on the company?
I like Bell. I think we're finally starting to see some momentum from BCE stock, and you're still getting a little bit of a dividend as well, of course. Telecom as a sector, sentiment's been quite poor, and I have been adding to my BCE over the past several months.
Okay, we've got an email now from Greg, and it's short and sweet. Is Shopify a buy or a hold at this price?
I think Shopify is a buy. Of course, they're subject to AI disruption, but they are a Canadian behemoth, and I think that they've typically proven the detractors wrong whenever there's been declines of this nature. Don't necessarily think we're maybe at the best buying opportunity from a technical standpoint yet, but it is something that I think people should have on their radar if they're interested in the stock.
And you're mentioning, obviously, you can see it here, almost down 8% on Friday. It seems like, depending on the company, of course, you like to go in and buy when it's a little lower.
I think sometimes I'm a bit of a contrarian by nature. When things are down or the market is very negative on something, I tend to take a closer look. Sometimes the market, I think, is right. Other times, I think that there's some near-term noise going on where there is an opportunity for a longer-term investor.
Okay. We're going to go to another email. This one coming in from Fred, and it says, I own ticker AG for a long time. Your opinion on First Majestic. That's First Majestic.
First Majestic is the silver stock, I believe. Yes. So that was down significantly. I don't follow First Majestic specifically, but I do follow silver. We do own Pan American, which is PAAS. And silver, of course, was a big news item on Friday as some of the leverage trading in silver unwound. One of the things that I've always liked about silver are the industrial requirements of the metal and also the supply constraints. Silver is often something that is a byproduct of other mining, so it tends to put at least a near to medium term cap on supply. So with increasing demand, the emphasis on precious metals, I think we're looking at the recent declines as an opportunity because I think a lot of the fundamentals for precious metals overall still remain.
Because, I mean, you can look at silver as a precious metal, and it often does what gold does, right? But it's also, as you were saying, like very industrial and used for a lot of things, particularly around AI.
Absolutely, yeah. I think it's a key component in electronics. I was reading a few weeks ago that 20% of all annual output of silver is actually just used in solar panels.
Wow.
So there is certainly a demand for it on the industrial side, on the high-end electronics. And as you know, I think the AI narrative gets built out with the data centers, as well as even just the defense theme in North America and in Europe. I think that's something that bodes well for those industrial metals.
Very interesting. Okay, another email, this one coming in from Max, and it reads, Starbucks is changing their loyalty program, moving away from rewarding customers who preload their app. Will this impact their cash flow and their price stock? What do you think?
I think it could. I mean, generally speaking, I'm a bit biased towards Starbucks because I go there every day. I like Starbucks. I think that their new CEO is doing a lot of the right things. And it's something that if you are a regular visitor of Starbucks, then you are actually probably seeing the impact that some of those changes are making. Mm-hmm. Simplifying the menu, changing the rewards program, and making them a bit more customer-centric. I think the CEO's track record, Brian Niccol, his track record with Chipotle is a very good one, and I think that I'm pretty optimistic on the stock in general. But as a segment, sort of that fast casual, fast dining had a lot of negative sentiment of late.
Yeah.
And I think that's something that, again, the contrarian in me is looking out for.
So Starbucks trying to simplify things, get back to what they used to be. Okay, we got another email coming in from Kathy, and it reads, can I get your thoughts on senior living stocks?
Yeah, so we own Extendicare, but Sienna, Chartwell, all very good companies. I think there's some excellent demographic trends, of course, with the aging population. These companies are very well run, and I think and they also provide a bit of a yield often. So I like the space, and it's something that we're invested in.
Okay, anything else that you're kind of watching out for before we wrap up here in terms of any companies that you're looking at?
Well, I think that for me, if there's another headline like we got on Friday about Bombardier, then that's something that deserves attention. I think we'll get more of those as we get closer to the summer USMCA deadline, and that's something that Canadians should be very aware of.
Yes, okay. Lots to watch for. Kyle, thanks so much for being in studio today.
Thank you.
Appreciate you coming in. And that's it for us here on The Street. Again, thank you to Kyle Taylor, Wealth Advisor and Portfolio Manager at TriDelta Private Wealth, for joining us today. And Andy Bell is with us for the open next. Markets are opening in just 30 minutes from now. Stay with us.